everyone, I'm Komal Sahai, and in this video we are going to talk about price indices. In a recent video that I posted, I talked about the basics of inflation. Now that video assumed that you knew what a price index is, you knew what a consumer price index is, what's a wholesale price index, but it just may be the case that for many of you, you don't know what they are, especially if you are from a non-economics background. So in this video, we are going to talk exactly about that. We are going to talk about what price indices are, and we're going to cover these points. So we'll start with what index numbers are, then we'll see how to construct an index number. We'll start from the simplest and then go to the more complicated methods. Then we'll talk about what are some of the common price indices in India. Then we'll move on to some of the important considerations that one must keep in mind while constructing a price index. And finally, we'll also discuss some of the most common other indices that are used, that we see all around us. All right, so let's begin. Let's begin this video by talking about some real world example. Okay, so the latest inflation data that was released by the government of India, so the Ministry of Statistics and Program Implementation, which is in short called MOSPI. Okay, so this ministry releases the inflation data, which is the headline inflation, the inflation which is based on consumer price index. So this ministry, in its latest press release, which comes out on the 12th of every month, it gave some of the numbers that it gave was this. So the first thing that it said was that the year-on-year inflation, we'll see what each of these terms mean. The year-on-year inflation in December 2023 based on CPI combined was 5.69%. So the general thing that you will read in the newspaper is that the inflation reported in December 2023 year on year was 5.69%. Okay, again, the year on year inflation in November 2023, again based on CPIC, was 5.55%. So these are real figures, you can check them in the newspaper or in the press release. Again, some of the other numbers. So the CPI combined in December, again 2023, was 185.7. In December 2022, okay, it was 175. So these are some of the numbers that the press release gives you. Some of the very basic numbers. Inflation year on year in December was this much, in November was this much, the CPI was 185.7 in December, and a year ago it was 175.7. So given our knowledge from the video that we did on inflation, we know some things, right? So we know that this number means that the inflation was positive, and therefore it means that the general price level rose. Year on year means that exactly at this time in the previous year. So year on year. There's also month on month, which means that at the same date in the previous month. So year on year means compared to December 2022, this is the inflation. This is the general rise in prices. This is the general percentage rise in prices. Similarly, year on year in November, it means that compared to November 2022, the rise in price was 5.55%. So we know this, the general idea, we know that in general the price levels rose, right? We know that CPI in December is this number, 2023, and in December 2022 it was this number. But what we don't know are several things. So the first thing that we don't know is what exactly CPI is anyways. And what is CPI combined? So if it is combined, there must be some parts also, some moving parts which is combined to form this particular CPI, right? Do we say, when we say that the price level has risen, does it mean that all prices have risen? Or some prices may have gone up, some prices may have gone down. If all prices have not risen, they've moved in both the directions, then how did we reach a number like this? How did we reach a number like this or like this? So these are all the things that we are going to consider in this video. And of course, the press release also mentions that the base year was 2012. And we will also understand what exactly does this mean. Okay, so now let's move ahead. Let's talk about how to construct a price index. So we'll start with the very basic, and then we will make it more and more realistic, more and more useful. Okay, so now consider, let's understand what a price index or generally an index number does. So price indices are basically an example of what are called index numbers. Index numbers are statistical tools. So to understand their utility or their purpose, think about the fact that suppose you go into the market, right? You go into the market to buy vegetables, and there you observe that, compared to say the last time you visited, you observe that prices of some of the vegetables are higher, prices of some of the vegetables are lower. So for example, you're comparing it with last year. So you observe that some vegetables have become costlier, some fruits have become costlier, while others have become cheaper. Now, how do you collapse this information into a form that is useful to understand, that can actually, when you talk to someone, you can give a conclusive answer. So you see that some of the prices have moved up, while others have also moved down. How do you collapse this information into a single number? One number that encompasses this entire information. And this is what index numbers do. So an index number is a statistical tool that is used to measure movements or changes in a group of related variables over two different situations. Okay, so let's talk about each of these terms. So index number is a statistical tool, and the purpose is that there is a group of related variables, and these variables have been moving, there are changes in these group of variables, and we want to measure the change from one situation to another. So these variables, for example, could be prices of say vegetables, prices of commodities in an economy, prices of services, prices of all things that are being produced in an economy. So prices, they are related to one another, we know that. It could be quantities of anything, quantities of say in any industry, you want to measure, you want to see how the quantity of production, how the volume of production has changed, right? And of course, even there, some of the things would have gone up, some of the production quantities would have gone up, some of them would have gone down. So these are related variables moving together, and you want to get a number for that using the statistical tool. This could also be, for example, say a group of health and wellness indicators. Again, as the say your society, your economy, socio-economic environment improves or degenerates, in either way, these variables will be moving together, right, in a related fashion. So it could be some health indicators, right, etc. And now, so we are trying to measure changes in these variables, A group of variables. So it's not one price, there's no one price. There's price of this vegetable, that vegetable, this fruit, that fruit, right? And what we're trying to see is how they have changed over two different situations. The most common situation in case of price index, for example, is two different time periods. This could be year, between 2 years, this could be months, right? It could also be two different geographical locations. For example, you're comparing countries, right? So you're comparing countries in terms of, say, their health indicators. So then the two different situations are countries. It could also be within a country, it could be rural, urban, these kind of things, right? So anywhere there are two different situations, that's why you're making a comparison. So this is what an index number does. You have a bunch of raw data which is telling you how every particular component of that data is moving. Some is going up, some is going down. An index number will give you a statistically sound scientific way to collapse that information into a number. That is an index number, and that exactly is a price index. Now, what is a base in this? A base will be the reference point or the benchmark from which all comparisons will be made. So suppose you're comparing between 2 years, then your base will be a year, a base year. For example, in the inflation data that I gave you, the base year was 2012. So all comparisons are made against 2012. We'll just now do a construction of an index and we'll see how exactly this works. Again, if you're comparing, say, countries and you're looking at India as the reference point, then the base is India and all comparisons will be made against India. All right. Okay, so now let's move ahead. Now that we have understood broadly what an index number is, let us now move to construction of an index. Okay, so let's just take a bunch of prices, a very simple example. Let's take a bunch of prices and see how an index number is constructed. Okay, so I have a written example that I would like to discuss. Let's just see. So suppose there are 4 items in whatever, like, the toy economy that we are studying. Okay, there is item 1, 2, 3 and 4. Okay, now suppose again the base year is 2012 and we want to see how prices have changed in 2013. Okay, so for example, the price of commodity 1 was 20, 50, 40 and 90, and in the next year the prices have moved to 25, 60, 30 and 100. Alright, so what we see over here is that the price of commodity 1, 2 and 4, they've gone up, while the price of this commodity has gone down. So now we have this raw data with us and we want to construct an index that captures this information accurately, just not anything, an accurate capture. So the first and the simplest way to do it, the simplest, PI stands for price index, and we'll call it 0, 1. Why? The starting period, in our case, which is 2012, we will call it T0. T0 because 0 is the starting point. For example, take the x-axis, take the y-axis. On any axis, you start on a point of, you start from 0, right? And then this is T1, 2013, because it's 1 year ahead. So 2013 is T1, 2014 is T2, 15 T3 and so on. So this is a comparison between the year T0 and year T1, right? Now, the simplest price index is going to do what? It is just going to take the ratio of the summation of prices here and the summation of prices here. So how do you write this? You write it as P, price of commodity 1 in year 1, T1, plus the price of commodity 2 in year 1, price of commodity 3 in year 1, price of commodity 4 in year 1, divided by, okay, again price of commodity 1 but now in year 0, price of commodity 3 in year 0 and price of commodity 4 in year 0. And then you multiply this by 100. Alright, so how do you write this in a more compact way? So what we'll do is we'll use the mathematical notation of sigma. Okay, so sigma. Sigma is the notation used for summation. So you're summing over something. So here what you're doing, you're summing the prices. Summing the prices of 4 commodities that go from 1 to 4. Okay, so how we will write this is that we will start with a marker. We'll call it I. We'll just see the notation and then you will understand. This goes from 1 to 4. And we will write it as PI1 upon sigma. Again, I is equal to 1 till 4. PI0. And we multiply this by 100. This is the price index. So what it means is that every time you will go on moving, you'll go on increasing the number of this I. So when you start with 1, so that is P11. Then you move ahead, you have to go all the way till 4. So what comes after 1? 2. So then P21, right? After 2 comes 3, P31, and then 4, P41. You stop at 4 because that's your stopping point written over here. Okay, so this is your starting point, this is your stopping point, and you move in integer values from here to here. When you open that, you will get this. And how do we know that we are going to add it? Because of this sign, summation. Right? So you add P11 and then you move from 1 to 2, you add P21 plus P31 plus P41. Similarly, in the denominator what you have is, again you have to move from P1 to P4, but now the prices are of the base year. So this is what you get, right? So you get P10, P20, P30 and P40, and after 4 you stop. Okay, so this is the shorthand notation for, because right now we have 4 prices, but of course the economy has thousands of prices. And in any case, whenever you're dealing with a large number of items, you want to write it in a compact way so that it is more tractable. So now finally what we have is, when we sum these up, what you will get in the numerator is 215, in the denominator what you will get is 200, then you will multiply it by 100. This is the numerator, the summation, this is the denominator, and then you multiply it by 100, you will get 107.5. Okay, so what does this number mean? What does this number mean? So what we have found is, let's just rewrite this. So this is the formula. This is the formula of the price index, the simplest price index that we are doing right now. We'll just remember this number and we'll just write it again. So what we have is that the simplest price index 01 was found to be 107.5. To understand what this number actually means, let us construct another price index which is not between the year 0 and 1 but between 0 and 0. So what does this mean? You will be taking ratios of the prices of these commodities in the year T0, and again the denominator will also be the year T0, right? So you will have sigma Pi0, right, upon sigma Pi0 into 100. Now these are the same quantities. You will divide the numerator by the denominator, which is the same. So what you will get is 100. Right? These cancel out. So what it says is that the price index in the year 0 is 100. And in comparison to that, the price index in the year T1 is 107.5. Okay, so that is why the price index in the base year is always 100 because of this formula. Okay, so now let's understand what it means. You have a bundle, right? This, if you could buy this bundle, you could buy a given bundle of goods in rupees 100 in 2012, right? To buy the same bundle of goods, now you will have to shell out 107 rupees, right? Or in other words, if you had 100 rupees in year 2012 and you still have 100 rupees in year 2013, then those 100 will not be enough to buy the same basket because now that basket costs 107.5. So the purchasing power of those 100 rupees have gone down. And that is what? That's inflation, right? How much is the inflation over here? We know that inflation is the price index in year 1, right? So since 0 is constant, we'll just take that, we'll just remove it from the notation for now. Minus price index in the year 0 upon the starting point into 100, right? So this is what? 7.5%. So between 2012 and 2013, based on this simple index, we have found that the inflation was 7.5%. Okay, 100 rupees became, or 100 rupees lost its purchasing power by this much. General price level rose by this much. Now you understand, price of this commodity actually went down. Okay, but in general, overall, our statistical tool over here says that the general price level went up. Went up by how much? Went up by 7.5%. This 7.5% encompasses not only the price increases, it also encompasses this fall. Okay, all right. So now this is the simplest price index. The obvious problem with this price index is that we don't know which of these commodities are more important in terms of which of these commodities are more popular with the consumers, right? So if a commodity which is very costly, and so for example, let's just take broad categories. Suppose there's food and then there is some luxury item. Now food is something that is very important. Food is something we cannot do without. So if food is being consumed by everyone, food is an important component of anyone's basket. And the weight that we give to food should be more. Food should get more weightage in this formula, right? So now the next improvement over this simplest index is a weighted index. So just to take the extreme example, suppose there is an item in this which no one consumes. It's an outdated item, or it's an item that is valued by a very few people. Somehow its price is going up or it's going down, whichever way, but no one is actually buying it. So that item is redundant from point of view of constructing an index where you want to see relevant prices. So now we will construct a weighted price index, weighted by the importance of a commodity. And how we will calculate the importance? We will calculate it based on how much of that good is consumed in the economy. Okay, so now we will need two other columns which will tell me that how much of this particular commodity, this particular item was consumed in each year. So let's just say that item 1 was consumed, so 10 units of this item was consumed, right? 5 units of item 2, 10 units of item 3 and 3 units of item 4. This was what the consumption pattern looked in 2012, and in 2013 in T1 the consumption of this item went up, also went up, also went up, and also went up. It can go in either direction, that doesn't matter. It's just an example that we are taking. So now we have this information as well, and this information is telling us the importance of each of these, the importance of each of these items. Okay, so how will we incorporate that into our index? What we will do is, we will multiply, right? So we have our summation sign over here. So this is again price index 0 and 1. We will sum the prices, but we will weigh each price by its importance in the basket, right? So whatever is the quantity, we will weigh it by that much. So when we had, let me just write it in terms of the individual quantities first. So what we'll do is, we'll take 25, right? These going in the numerator. So we'll write 25, but we will multiply it with 100. Sorry, with 10. We will multiply it with 10. Because the economy is consuming 10 units of this item. So this price appears 25 times. So this price appears 10 times. 25 appears 10 times. That's 25 into 10. Again, the next price is 60. This appears 5 times in 2012. 30 appears 10 times. And 100 appears 3 times. So what we have done is that we have weighed each price by its importance in the economy. So 1 and 3 are consumed more, so they are weighed more. Similarly, in the denominator, what we will have, now we will take prices of 2012, so 20, and we will again weigh them by the basket. So 50 into 5 plus 40 into 10 and 90 into 3. How do we write it? In terms of summation, we have I equal to 1 going up till 4, P I 1 Q I 0. So we understand what PI1 means. We understand that it goes from P11 to P41, right? What does this mean? Again, the same way we will read this. This means that we will go from Q10 to Q40, and we will get each of these numbers. When we get P11, we multiply it with Q10. So P11 multiplied by Q10, which is 10. Similarly, P21 multiplied by Q20, which is 5. Okay, and we will divide this, again summation going from 1 to 4, P I 0 Q I 0. So now we are multiplying these two quantities. You open it, P10 times Q10, P20 times Q20, and you will get these numbers. And of course, you multiply by 100. This is called a weighted price index. You weigh every price by its importance in the commodity basket. Alright, so now I'll just tell you what this number is. I calculated it. So you will get in the numerator the summation of this. Let me just write it here. So summation of the numerator is 1150, and the denominator is 1120. You multiply it by 100, and what you will get is 102.68. Let's just call it price index weighted. So when you do all this calculation, this is what you will get. You can check it and you can do the multiplication and division on your own and check it. So now let us interpret this. Okay, let us interpret this. So what we have done over here is that, of course, we have weighed each of them by the quantity that they had. We know that price index in 2012, right, is 100. It doesn't matter whether you weigh by anything or not, you will always have the numerator and the denominator same in the base year. So then this is equal to 100 and the price index here is 102.68. Sorry, this is 68. Okay. So now what we have is that the rate of inflation is 2.68%. You just subtract this from this, 102.68 minus 100 upon 100, multiply by 100, you get 2.68%. Now you see the difference. The inflation rate over here, the weighted inflation, is this much, and the simplest inflation was 107.5. Why is this different? This is different because the commodity, right, what we were doing in the simplest, in the previous simplest calculation of price index, we were giving every item, every price equal weight, right? So when we were summing them together, what we are doing, we are multiplying 25 by 1, 60 by 1, 30 by 1 and 100 by 1. That means that we are treating all of these prices equally. But now when we have information on the commodity basket, we know that consumers are consuming a lot of this commodity, right? Consumers are consuming 10 units of this commodity, right? The other commodity is this, and these two are relatively, the commodity 2 and 4 are relatively less important in the consumer basket. So because this item whose price has gone down, that's a pretty important item in the commodity basket. That means the downward movement in the price of this commodity will get more weight, right? And because of that, the inflation number has been pulled down. Whereas the non-weighted inflation number was 7.5%. Now that we know that the price of a very important commodity has gone down, right? The overall rise in price level, the net rise, is by a lower amount, only 2.68%, right? The price of most commodities have gone up, but the price of a very important commodity in the consumer basket has gone down. All right. So that's why weights are important. If you are giving equal weight to a commodity that's very important, you're wrong, right? It's not the statistically correct way to do it. Again, if you're giving equal weight to a commodity that is not being bought anymore, again, that's a mistake. So that's why index numbers, when they are weighed, they are a correct statistical way to condense this information into a number. What does this, how can we interpret this intuitively? Think about it. Suppose you are someone who is living in 2012, right? And this is the basket that you were consuming. So you're consuming 10 units of item 1, 5 of 2, 10 units of item 3 and 3 units of item 4. Now, if you want to consume the same basket of commodities in 2013, then what will be the price of that basket? So if this basket was costing you 100 rupees in 2012, this basket will now cost you 102.68 rupees in 2013. This basket has become costlier. The same basket that you were consuming in 2012, now it costs you 2.68% more. Okay? But this is just one basket, right? What if we want, another, what's another possible weight that can be used? Why not use these numbers? You can. Okay, so when the weight that you have used, when you are using the weights of the base period, right? When you are using weights of the base period, then this index, this price index is called the last year's price index. Last year's was a person. Okay, so he was the one who came up with this index and it's named after him. So when you're using the weights of the base period, where you're saying that you want to see how much the affordability of this basket, which is in the base year, how much that has changed over time. Then you are using the last year's index. On the other hand, if you are weighing each of these prices by the commodity basket in the current year, okay, so another thing that you can do is that you can write it like this. So sigma price in year 1 weighed by the quantity in year 1. And similarly, price in year 0, but the weight remains the same, quantity in years 1. So now you are saying that I want to see how much this basket, right, how much this basket will cost me in both the, in the 2 years, right? So the obvious problem now with this, so now when you calculate your price index this way, when you're using this formula, when you're using the weights of the current period, right, of T1 or whichever period that you are measuring the basket in, this is called a Pasch's price index. Again, name of a person. This person came up with the idea that we should use the current basket instead of a basket that existed in the previous year. Now see, there are merits to both these arguments. There are merits to using this basket as well as there are merits to using this basket. The merit of using this basket is that you can, suppose you measured that what is the consumption pattern of people in 2012. Now for all the years in which you are using 2012 as the base, you can use this, right? You've done the exercise once and then you can keep on using the same basket. Unless you change the base year, this data will be handy. It can keep on being used again and again. Whereas if you use this, then with every year in 2014 you will have to again do the same measurement. See the consumption basket, 15 again 16, whichever year you're taking, you will have to again measure the basket. So from the point of view of measurement, this becomes a very hectic, cumbersome task. It's a costly task. Whereas there's also argument in favor of it, and that is because as time changes, of course the consumption pattern changes, and the Pasch's index takes account of that. If I'm using the same consumption basket, right, as previous year, that means I'm saying that if I'm saying that let's use that, then I'm inaccurate, because we know that every time with every passing year the consumption pattern changes. So the Pasch's index takes into account this change in consumption pattern. Okay, now since we are looking at only 4 commodities, you may think that this is not a big deal, right? Just go ahead and again measure how much of each commodity is being used. But in an economy, there are thousands of goods, there are thousands of prices, there are billions of people, right? And then how do you go about doing this exercise every time, every year? It's a very costly undertaking. So in India and in most of the places, in the spirit of being judicious with your money and time, using this as the weight is more popular. Okay, so now let's continue with that. Let's go ahead with that, and let's do a little manipulation. So what we have is that the last year's index, let's just call it the last year's index, and this is the formula. So we have sigma P1 Q0. I'm not mentioning the runner from here because we're just manipulating the common formula. It can be any number, that doesn't matter, because we are just, that's not useful right now. Okay, P0 Q0. So this is the formula that we have. This can go for any number of commodities. What this means is that this is the last year's index because we are taking the basket which is in the base year, T0, right? T01. So now what we can do is, we can write this, let's look at the numerator over here. Since this is a multiplication, we can write this, this is the same, so sigma P0 Q0, okay, into 100. We can write this as Q0 times P1 upon again, right? No change from there to here. What we can do is we can multiply the numerator, we can multiply and divide the numerator by the same number. Suppose we write it like this, P1, and we can multiply and divide it like this. Why? Because this is just going to cancel out, and that means that we are just multiplying this entire quantity with 1, and that doesn't change. That doesn't change the value. But what it helps us is that it helps us to write it in an alternate way. So now we can manipulate it and we can write it like this. So I'm just rubbing this one. This can be written as sigma. I'm taking this and this together. So I'm writing Q0 P0, and I'm taking this and this together, times P1 by P0 upon, of course, the denominator remains the same, multiplied by 100. Okay, now let's understand what this is saying. First of all, nothing has changed from here to here. These two are exactly equal. So whatever interpretation that you had about this, the last year's price index, it's the same here. It's comparing that what a basket of goods that was being consumed in the base year, how has its price changed from the base year to year T1. That is, this is still saying the same thing. But we have manipulated it because we want to bring it to a form that is more usable. Let me just tell you how. This quantity, this is called a price relative. What is this? This is just a ratio of the price of a commodity. Suppose item 1 we are looking at. This is the price of item 1 in year T1 divided by the price of item 1 in year T0. Right? This is the price relative. And now, each of this price relative is being multiplied by a quantity Q0 times P0. This is the weight. This is the weight, just mathematically, right? This is the weight that is being attached to each price relative. Earlier, we were summing this quantity, right? We have just manipulated this numerator like this. It's still numerically exactly the same, but now it can be interpreted in a slightly different way. So earlier we were saying that price of commodity 1 times quantity of commodity 1, right? price of commodity 1 in year T1 times quantity of commodity 1 in year T0. Now we are saying, so this was the weight given to every price. Q0 was the weight given to every price. Now we are saying that Q0 P0 is the weight given to every price relative. Price relative, price ratio, whatever you want to call it. Q0 P0 is the weight being attached to every price ratio of the commodities. So for commodity 1, you have the price ratio in year T1 and T0, and this is the weight. Now what is this weight saying? This weight is Q0 times P0, which means it is the, what is this? This is the total amount of money that was spent on commodity 1 or any commodity. Let's just take for example commodity 1. This is the amount of money that was spent on commodity 1 in year 0, right? So this is the expenditure on a commodity or on an item in T0. Okay, so earlier we were just weighing it by the amount that was consumed of that commodity. Now we are weighing it by the expenditure that is being made on that commodity. Okay, so we are saying that every price ratio, the ratio of price for every commodity is being weighed by the expenditure that was made on that commodity in the base year. And in the denominator, we are just summing over all those weights. Now, why I am talking about this? Because this is the form in which the last year's price index is used to calculate the consumer price index, the wholesale price index in India. Okay, so that brings us to the third topic, which is the common price indices that there are in India.